All right, got it. All right, our first presenter today is Jerry Mingione. Jerry is a member of the American Academy of Actuaries, Social Security and Pension Committees. He served as the primary author of the Social Security Committee's analysis of the Social Security retirement age issue. He frequently presents at industry meetings on investment and capital market related issues before a range of industry groups, including the Conference of Consulting Actuaries, the Academy, the Society of Actuaries, the Conference Board, the Institutional Investor Institute, and the Institute for International Research. He serves as an advisor on pension financial issues for the city of Detroit and in other consulting roles focused on capital market related issues. In a previous role at Willis Towers Watson, he created a unit that was responsible for the development of the firm's forecasts, discount rate models, and benchmarking databases. Please help me give a warm ACSW welcome to Jerry. Jerry, the floor is yours.
Okay, good morning, folks. It's not morning here anymore, but I believe it is for you guys. So what we're basically going to talk about is the financial status of the system and what's driving the financial status. And then after we talk about that, we'll switch to the system's in trouble and what are the options to fix it. Okay. Another disclaimer, this is a presentation disclaimer. Basically, even though the Academy has sort of provided a lot of the information that I'm relying on, as well as the Social Security actuaries, the analysis of that information and the conclusions based on it are my own and not necessarily theirs. So, as I mentioned, sorry about that. As I mentioned, what we're going to talk about first is the Social Security's financial position and what drives that financial position. And then we'll switch to the last pension reform legislation that was really critical was in 1983, when the system's financial situation was essentially stabilized. And then we'll talk about why that solution didn't quite hold up as it was expected to. And so now we're going to need new solutions, and what do those new solutions look like, and how can we evaluate them? Okay. So when we're talking about the Social Security system, we have to realize that the system actually has two sometimes conflicting principles. The first is it's a safety net for everyone. It provides income to protect against poverty, essentially, in cases of retirement or disability or death. But most of the benefits are obviously paid at retirement. And there's a second principle that actually is helpful in terms of providing broad-based support for the system. I'm going to need a few more clicks. Okay, there we go. And that is the fact that everyone is part of this, even the folks who don't necessarily need it. Nearly everyone contributes and benefits. Everyone pays a flat contribution as a percentage of covered earnings, and everyone's covered by a formula that the more you pay in, the more you get. That formula, albeit it's progressive, every dollar of tax still results in a dollar or some portion of a dollar anyway of benefit. So switching to financing details, this just talks about what happened in the year that just closed, 2022. The system brought in 1.22 trillion, and it paid out 1.24 trillion. So obviously the trust fund was depleted by $20 billion. So it started out at 2.85 and ended up at 2.83. On the income side, you can see that almost all of the income is payroll taxes. There's small increments from taxes on Social Security benefits, which a lot of folks don't know probably. The taxes applicable on Social Security benefits go right into the system, and trust fund interest. On the ALCO side, it's almost all benefit payments. The administration is very lean compared to the size of the program. Okay. So this is the actual measure that the actuaries tend to use. It's not one that's familiar so much to pension actuaries. Basically, they take a present value of cash flow over 75 years. So they're not worried about what happens in year 76. It's a present value of all the years up through then. So the present value of all the costs is 17.4%. The present value of all the income is 13.8%. And subtract one from the other, you get the deficit that they publish of 3.6%. I should note that obviously the fact that they have assets at the start of the measurement period plays in, and they have a target for assets at the end of the period, which is essentially 1 times benefit payments. And so both of those, the initial assets, which are way above 1 times benefits, and the ending assets, the target being 1 times benefits, they both play in. So these aren't pure income and pure costs. They're affected by the assets. Okay. So this is a graphic that basically shows you what's being present value. This is year by year inflows and outflows, and you can see how the system evolved. Basically, there was a big surplus. The green line is above the blue line on the left side. So there was a big surplus basically in the 90s and 2000s, and that surplus ended with the economic collapse in 2008, because a lot of folks left the workforce and went into collection mode. And so that drove down payroll, and it drove up benefits. And that put the system in a cash flow depletion phase. However, the trust fund didn't start depleting back then because the interest on the trust was still enough to cover the gap and a little bit more. It just stopped covering the gap. The interest was incapable of covering the gap just within the past few years. So we sort of hit a peak about 2 years ago of trust fund balance, and now we're slowly starting to pull the trust fund balance down. So you can see the big spike that goes from about 2008 to into the 2030s, and that's the baby boomers retiring. Once the baby boomers retire, the retirement population is pretty stable, and everything you see after that, the blue line going up after 2035, that's the effect of increasing longevity, because by then the population that's being paid out is fairly stable. Okay. This is looking at the financial situation a couple different ways. One, the Social Security actuaries like to look at the trust fund not in absolute dollars, but as a ratio to benefit payments. And so that ratio peaked in the 2007 to 2011 period at about 3.5. The trust fund ratio was 3.5 times the level of benefit payouts, and it's slowly starting to decline. We're not in a deep decline phase just yet, but we're about to enter it. And so by 2034, the trust fund will be just about out of cash. And that's a deterministic projection based on what the actuaries call the intermediate assumptions. And anytime you see anything quoted in the newspaper, it's going to be based on a deterministic projection under intermediate assumptions. On the right side, they also do a stochastic model. The median, or the red line, pretty much matches the deterministic. And they also do, various percentiles, and I'm showing the 2.5 and the 97.5. And those range from depletion instead of 2034, depletion as early as 2031, and as late as 2040. Okay. So we're going to overview what drives the system, and then we'll get into detail after that. The first thing that drives the system is the population and what age groups they're in and how long they live. So basically, we're interested in the size of the work eligible population, and the size, comparing that to the size of the retirement eligible population, and the period of time folks are in retirement and receiving benefits. And the second relevant factor is whether those folks work and what percentage of workforce participation we have. And all of that, the age bands and when people work and when they retire, impact the dependency ratio, which is something that's very closely tracked, and that measures the number of workers divided by the number of recipients. If that ratio is healthy, the system's healthy. When that ratio is not high, the system is under strain. And not irrelevant is how much those workers that are working earn. And so the more productivity there is, the faster the payroll growth is, the healthier the system will be. You might say, well, won't those folks who earn more money get bigger benefits? Yes, they will, except that the system's evaluated on a pay-as-you-go basis, cash flow basis. And if you are 40 years old and making a lot of money, you will not be collecting benefits for 25 to 30 years. So the system is going to benefit from your additional taxes way before it has to pay you additional benefits. So that will make the system look healthier. And last, and not necessarily least, is when the assets do accumulate, they earn return. That return is kind of complicated how they calculate it, but it's based on basically on bond yields on treasury bonds. And so it impacts the growth of the trust funds. It impacts the amount of interest that offsets the benefit payments and supplements the payroll taxes. But the main impact of trust fund return is during those years when the trust fund is accumulating big sums of money and buying bonds. Once the trust fund stops accumulating funds and it gets into drawdown mode, the yields on new bonds don't matter quite so much. Okay. So I did see a question about the intermediate assumptions. Are they the most likely? The Social Security actuaries would say yes. I mean, that's how they would describe it. And they do a high cost set of assumptions and a low cost set of assumptions, but no one believes that the high cost set of assumptions and the low cost set of assumptions are fully credible. So to some extent, they shed some light on what could happen, but the package as a whole is not viewed as totally credible. So we're digging a little bit deeper into the assumptions on the demographic side. We've got three basic assumptions: longevity, how long people live; fertility, how many babies are born; and immigration, how many folks cross the borders and supplement the workforce. So mortality, the actuaries assume the kind of mortality progression that you're used to. We'll look in detail about exactly what that looks like in a bit. Under those assumptions, the life expectancy at 65, this is blended male-female, goes from 19 to about 22 over the next 40 years. At the start of the Social Security program back in the 40s, it was much lower at 12 or 13. So it's obviously grown a lot since then. Fertility, we talk a lot about the baby boom when fertility rates were super high. They were around 3.5. They shrunk a lot since. They've been basically in the 1.7 to 1.8 zone in recent years, and the actuaries are a little optimistic and projecting they'll go back to 2.0. Immigration, basically, we had a little bit of a lull in immigration in the latter half of the last decade. Immigration's picked up a little bit over the past year and is projected to be a little bit higher over the next couple of years in the 1.3 million to 1.4 million range. The actuaries project it'll slowly taper off to about 1.2 million over the long term. And so we look at the result of all that on the right side, the population count as it is, as it has been, as is projected. And so you can see that we tabulate the folks in the zone eligible to work, say 20 to 64. And then the zone of people eligible to retire, 65 plus, and tracking the ratio of those two, you see that it used to be super healthy when the baby boomers were just getting into the workforce. It was above 4.5. Now it's 3.5, tending down to closer to 3 over the next few years, and it'll go down to as low as 2.5 years from now. So you can see that an amiable environment for demographics is turning to one that's much less amiable going forward. Okay. I did see a question about COVID and whether COVID had much of an impact. Yeah, that's the slide you need. And the fact is that COVID didn't really have too much of an impact on people collecting. It had an impact on taxable payroll, and it drove the economy crazy. So there was a temporary blip in lots of things. How many people were working, how much they were making, but surprisingly not in the benefit payout. That remained pretty stable. Unlike the last recession back in 2008, 2009, when tons of folks started collecting, that didn't happen this time. Anyway, so now we're going to switch to the economic side. So what drives it on the economic side? Well, labor productivity, which drives payroll growth, which drives taxable income. Real payroll growth is projected to increase at about 1.4% over the next 10 years, phasing down to 1.1% over the long term. This is, again, a little bit optimistic because since 2000s, for the last 20-ish years, we've only gotten about 0.7%. Workforce participation, with the baby boomers leaving the workforce, we're struggling to keep the workforce growing. The projections say it'll grow at about 0.4% per year. That isn't fed by fertility. That isn't fed by new babies. That's mostly fed by immigrants. And this compares to 0.6% over the prior decades and 1.4% if you go back to the 80s and 90s when the baby boomers are entering the workforce. Retirement patterns, I should start by saying retirement patterns aren't real critical to the system's health because of the fact that there are big reductions if you retire early and big increases if you retire later. So the system's health is not that much affected by when you retire, although having more folks working and paying taxes is a good thing in general. So anyway, the actuaries extrapolate from recent patterns. We'll look at what those patterns have been. They include at least a slight delay in retirements compared to where they were 10 or 15 years ago. And the trust fund returns, the thing that I'd like to say about the trust fund return is don't overestimate the impact of today's increase in rates because the system is in depletion mode and is not buying a lot of bonds, so that even though current yields are pretty high, portfolio returns have only been about 2.5% in recent years, and they're only projected to grade up to about 3% over the next 5+ years. So now we're starting to summarize what all of these things mean to the system. And so demographics and longevity, the number of workers and the number of beneficiaries, that is driven off the demographics we looked at before, how many folks are in the working eligible zone and the retirement eligible zone, but this is how many people are actually working and actually collecting. And again, we have a ratio that assesses the system's health. When the system was very healthy, that ratio was 3.4. That was the 90s and 2000s. It's grading down. We're maybe just a little over the midpoint of the slide down to the doldrums when it'll be only 2.2. When there's only 2.2 workers producing for supporting one beneficiary, we have a problem. The tax rate that's necessary to support that portion of a beneficiary is probably a lot higher than folks are used to, and maybe higher than workers are willing to pay. So that's when push comes to shove in terms of what reform options have to look like to lighten the load a little bit. So on the right, we have this graph that says this is what the ratio has actually been. This is what it's projected to be. And we're comparing it to what the folks thought back in 1983 when they designed the last reform solution that worked. They were pretty good at projecting what it would be up until about 2018. Then after that, they become much more pessimistic than what actually occurred. So the fact that that solution didn't work is not caused by demographics. They knew what the demographics would be. In fact, they were more pessimistic than it actually turned out to be. Okay, next page. So this is just a graphic look at stuff we've already talked about. You can see life expectancy, you see the little blip due to COVID, but the actuaries were pretty optimistic. They project it'll go right back to trend, which is more optimistic than you necessarily were going to be. Now here you see the baby boom generation on the fertility graph. You see how high the fertility ratio went, and you see the big dip after that, and then a little bit of a pick in the 90s and to 2000s, and then it started falling again, and the actuaries a little bit optimistic about it going up in the future, but still short of replacement level, which demographers say is about 2.1, 2.2. Okay. This is a little deeper dig into immigration counts. If you read the newspapers, you would get a totally misleading effect on the bottom line immigration counts. You'd think they're much more volatile than they actually are. They are volatile, but not that volatile. What basically happens is you have legal immigrants, which tend to be about 800,000 a year. And then you have other than legal immigrants, which tend to be the rest. And that could be as many as 40% of the total, or it could be almost zero, because just as many illegals are leaving the country as coming in. And that's what tends to happen in bad economic times. And in good economic times, our economy is like a magnet and drawing more in. So basically, we've had total net immigration counts somewhere in the million-ish range, and it's projected for 2020 to 29 to be about 1.4, grading down to something like 1.25 over the long term. Okay, now we talk about payroll growth. Payroll growth might be easy to underestimate in terms of how powerful it is, but it's very powerful. How big a footprint every worker has in terms of paying payroll taxes is really critical to the system's health. So if the system's underperforming in terms of payroll growth, it's as though the number of workers is shrinking, essentially, in terms of their ability to support the retiree burden. So if wages are underperforming, as they have been ever since 1970, compared to what the trustees thought when they crafted the last solution, they thought it would be about 1.5%, and it's hardly ever been that except for the 90s. So every worker is coming up a little short in terms of the taxes they pay, and thus their ability to support retirees. Okay. So why is the payroll growth coming up short? Well, there's lots of reasons. The first is that even if the economy is growing as expected, and it might have been close, compensation share of gross national product has been shrinking. Ever since the 70s, labor is getting a smaller and smaller share of gross national product. And this is even though more people have been working. So in the 50s, we had 59% of the folks 16 and over in the workforce. It peaked at 67%, and now it's about 63%. But that did not drive an increase in compensation for labor as a share of GDP. So we have this problem that you can see in those two graphs, declines from about 59, 60% to about, let's see, so it was about, it started out about 64% on the left-hand side, and it ended up about 59, 60 on the right-hand side. That's a drop of about 7 or 8%, which is big. As a share of gross national product, labor is getting 7 or 8% less. Adding to that, making it even worse, is that this is total compensation, including fringe benefits. And more and more of that total compensation has been siphoned off for medical costs. So medical costs aren't taxable by Social Security, so that's a problem. And another problem is more disparity in who's getting compensation. And so because there's a hard cap on Social Security taxes at 160,000 today, the more income goes over that cap, it's not taxed by Social Security. That impairs the health of the system, and that percentage of income has been going up. It was about 10% back in the 80s, and now it's about 18% that goes above the cap. Okay. The trust fund returns, I've alluded to this earlier. They're critical. They've been coming up short. The folks back in 1983 anticipated 4.6% real on trust fund returns, and they have not been getting that. I'm sorry, 4.6%, that's nominal, sorry. And they've not been getting that since 2010. So we've been coming up short to 2010, and the graph on the right side shows why that's important, because the trust fund balance just happened to peak at the exact wrong time when interest rates were bottoming out. So that's been a bit of a problem in terms of the trust fund doing the work that it was anticipated to do. It's coming up short in terms of interest return. Okay. So I've been alluding to 1983 legislation. To me, it's like the holy grail in terms of good legislative performance. The folks back in 1983 at least tried to be forward-looking. They passed a bill that was way bigger than it needed to be to solve the immediate problem in 1983. They tried to solve the problem all the way into the 2060s. And so what did they do? They increased payroll tax rates. They were already going to increase, but they increased them faster than they needed to. They increased normal retirement ages, which, as you know now, every time this gets brought up, folks recoil at the prospect of increasing normal retirement age. Well, they took it on then, but the secret sauce that they use is they graded in over a very long period of time. So a lot of the people involved in the arguments weren't going to be affected. They made some system benefits taxable. When I talked to folks who were involved in system design back then, I think everyone knew that it was really a benefit cut for high income recipients, just disguised as a tax increase. Basically, it to some extent it made system benefits means tested. So the intent was to increase tax income for the baby boomers in advance of their collecting the money, thus building up the trust fund. That there had been no trust fund of any significant size before 1983. So they built up the trust fund so it would pay the excess benefits associated with the baby boomers once they retired, and it wouldn't be depleted until the 2060s, when, if you do the math, there aren't going to be any baby boomers around. So all their excess benefits would have been paid, funded during their working lifetime, and at the time the trust fund was depleted, there would be no baby boomer bulge to be worrying about. However, that solution came up about 30 years short of what they planned it to be. Okay. Before I get into why that solution didn't work, let's just talk about retirement age just a little bit. When are people actually retiring? Well, the folks started retiring earlier in the 80s, 90s, into the 2000s. So back then, if you look at the table, 52% were taking their money at age 62, the earliest they possibly could. Only 4 or 5% were waiting until after normal retirement date. And the average retirement age was way short of normal retirement date. It was 63.6 during that whole period. Over the last 15 years, that started to change. As of 2021, 25% of the people are taking at age 62 compared to 52%. So we're way down on people taking at the earliest age. Normal retirement date, 21% are waiting till after normal retirement date to take the money, compared to 4 or 5% before. So that drove the average retirement age up to 65.1. I should mention, you see that dark line there between 2005 and 2015. The reward for taking benefits after normal retirement date went up to 8% in 2008. So folks are pretty smart. Once that increment for late retirement went up to 8%, taking advantage of that was a pretty smart move, particularly when interest rates were very low and your return on money wasn't going to be anywhere near that. Okay. So the 1983 solution didn't work. The $2.8 trillion trust fund is starting to be drawn down. It was always scheduled to be drawn down, but maybe not quite this early, and the starting trust fund was supposed to be a little bit bigger than it is. So when it's drawn down, unless there's a solution, we're talking about benefit cuts on the order of 20%. So you can see on the graph on the lower left, you see that the solution went in 1983. You see there was no measured deficit then. And the deficit started climbing throughout the 80s, but it wasn't really particularly high until the 90s when it started getting measured over 2%. And then it stayed fairly stable until the last 5 years or so when it started climbing above 3%, until now it's at 3.6. And the graph on the right is the one we've seen before, how the payments have started to become well in excess of the income. Okay. Another look at why it didn't work is attributing the losses since 1983 to causes. And so basically the actuaries put this together every year. They do attribution of all the losses since 1983 to causes, and a lot of folks will look at that last one, the underlying demographics trends, and say, well, that's the main driver. Well, yeah, it is the main driver, except that was known. As I showed in a graph earlier, the 1983 architects knew exactly what was going to happen to demographics, so that's no surprise. So we were always going to be in a deficit position looking out 75 years from 2023, but we were not supposed to be in this big of a deficit position. So what caused the loss, in addition to the underlying demographic trends, was mostly economics. So what about the economics? Well, there was some slowdown in productivity growth. As we saw, there was a reduced share of economic growth making it to worker compensation. And as I mentioned before, there was a diminished portion of worker compensation making it to taxable payroll due to increasing healthcare costs and increasing income disparity. And last was the declining return on trust fund assets. Everything else pretty much cancels out. Okay. Addressing the Social Security imbalance, basically we have to look at three things. We have to look at tax increases, retirement age increases, and reducing benefits for the higher paid. That's in a lot of the programs. Not necessary, but you'll see in a lot of the programs. Other less significant fixes that you'll sometimes see are increased minimum benefits, particularly when there's a retirement age increase provision, increasing the minimum benefits to take some of the hit off low-income workers who might have blue-collar jobs. So having a higher minimum benefit kind of offsets that a little bit. Reducing inflation indexing, increasing the taxation of benefits. All those things are often included in proposals as well. I should mention that when you're planning a program change, it's very sensitive because there's a strong practical interest in maintaining the social pact in which nearly everyone pays and nearly everyone benefits. So the more you stray from that social pact, the more you are vulnerable to losing political support and having the program as a whole become politically vulnerable. Okay. So this is my own contrivance. I take all of the different provisions that are out there and different reform packages, and I try to sort them in terms of which folks are interested in them politically, the progressive side or the conservative side, and which ones help financing and which ones hurt financing. The ones that you see the most, raising the maximum tax base, that would be progressives mostly proposing that, and it will help financing. Raising the tax rate, again, progressives and helping financing. Conservatives don't always go for programs that will raise the tax rate. They tend to want to, as we go to the bottom left quadrant, they tend to want to raise the retirement age. They tend to want to use change CPI. Occasionally, they'll want to cut back to a basic benefit rather than the income-related benefit that we have. Those are the main ones, and we'll go into a little more detail coming up. So now when we want to assess reform proposals. Oh, sorry, yeah. So when we want to assess proposals, basically, there are two interesting frameworks from which to assess. One is we'll call it individual equity, and that is if you pay $1 into the program, you expect something back. You expect some value back. It may not be exactly $1, but you expect something related to what you paid in. So what supports that is that formula benefits are paid regardless of need. You could have an income of $1 billion and you'll still get your Social Security check. The payroll tax rates are a flat percentage. They're not, it's not progressive, it's flat. And the benefit formula provides higher benefits for every $1 of tax you pay. That's individual equity. Now we go to the other objective, which we'll call social adequacy. Social adequacy is about mitigating poverty. So the way we do that is we replace a portion of income when a worker either retires or dies or becomes disabled. So when you die or become disabled, you obviously haven't paid as much into the program, but you're covered anyway. So to that extent, it is insurance. It provides income to spouse or other dependents, whether they've worked or not. And the formula is tilted pretty strongly towards the lower income workers. Okay. So these are two quantitative analyses that are attempted to go after those two measures. And so the first one on the left, basically what we've done is we've assessed the current program as it's written, and then we've assessed it as it's payable based on current taxes. As we know, benefits are going to be cut if we don't change something. So basically that's what's showing up as the red line. So the system on the left-hand side, the individual equity, the system's pretty healthy in terms of providing bang for buck as it's drafted. It provides $1 of benefit, according to this measure anyway, for more than half of the workers. But as is payable, not quite as healthy. Only about a quarter of the workers are getting bang for the buck, and everybody else is paying in more than the benefit they're getting out. Now, social adequacy, removing poverty. There are two poverty measures shown here. The bottom one is absolute poverty, and the top one is 150% of that, or 25% of national average wage. So the system as written is pretty good at eliminating pure poverty, even down to the lowest income levels, but the system as payable is not quite as good. Okay. So retirement age considerations, it's become sort of the third rail of politics. Every time it comes up, there's a lot of railing against it, but it's a rather obvious adjustment that you would make to a program like this when you have bad demographics, and to some extent, the bad demographics are caused by increasing life expectancies. It's the first place you would tend to look, is having people work longer and changing the borderline between work and retirement. Doing that essentially helps to fix the system in terms of the payout versus income disruption. However, if you back up a little bit, there's an even broader rationale for increasing the retirement age, and that is more workers mean more gross national product, and more gross national product means a wealthier society overall, and a wealthier society overall is better able to afford entitlement programs. So we look at the life expectancies, what they've been, blended male-female here. In 1940, about 12 and a half, currently about 19, projected in 2060, about 22. So we will have had 6 to 9 years of increasing life expectancy, but as the program is written now, only plus 2 years of anticipated additional work to get system benefits. So in addition to the baby boom, this mismatch implies an ever-increasing burden on the proportionally smaller working group. So it's creating a lot of pressure, and there are very few ways to mitigate that pressure other than changing that borderline. However, a lot of the objections to having folks work longer is that it's more feasible for some workers and occupations than others. When you look at mortality statistics, I don't know how many of you actually looked at it this way, but they're highly correlated to education and income. And the folks with more education, more income tend to have softer jobs in terms of physical requirements. The lower income jobs tend to imply greater physical demands. So there's a lot of ways to mitigate that other than abandoning the whole project. One of them is increasing the minimum benefit, which we talked about. Another is softening the definition of disability at some point to maybe be only your own occupation, maybe after a certain age, 60 or 62 or something like that. So it's a pretty harsh definition of disability in the program now, and one option will be to soften it up. Okay. So we do have some key proposals that have been focused on over the last 5-ish years. One from Larson, who is a Democratic congressman, and his basically improves the program and raises taxes. So we already have to raise taxes quite a bit, and when you improve the program, we have to raise taxes even more. So that's a big tax proposal that Representative Larson has. On the Republican side, uh, Johnson has a proposal that's almost the opposite. His is to cut Social Security down to essentially a basic income program and not raise taxes at all, which, as I mentioned before, is a little bit scary in terms of turning the program essentially into a welfare program for retirees. Jeopardizes the broad-based political support it's always had in the past. So the Bipartisan Policy Center tries to come up with a compromise, the skate in the middle, and it's half of one and half of the other, does a little of this and a little of that. For example, it increases payroll tax a little bit. It drops benefits for high income a little bit. It increases normal retirement age, but it phases it in extremely slowly. So by 2070, it'll be at 69, which is a really long phase in. So anyway, that's what they're trying to do. Okay. So now when we analyze these kinds of proposals using the metrics that we talked about before, basically what we see, so in this case, the current system is the black line that's coming in at the bottom. On the left side, the black line coming at the bottom is the current system. And you can see that every one of these proposals has increased benefits for the lower paid folks, every single one. And most of them, well, actually, the bipartisans have left benefits alone for higher paid compared to what the system's currently able to pay. Johnson has cut them. The Republican proposal will cut benefits for the higher paid, whereas the proposal coming from the progressive side will raise them for the higher paid. And then we go to elimination of poverty. You can see that the bottom line, the black line, is pretty much failing to eliminate poverty. We saw that a few slides ago. And all the others are doing way better at eliminating poverty on the left side of the page. Okay. So in terms of reforming Social Security, the time is of the essence. A lot of folks say you got to move quickly because the earlier you tackle it, the more people can be roped into the solution. If you wait until the very last minute, usually most of our proposals have left retirees exempt from changes. So that limits the amount of folks that can be affected. And it takes a lot of things like benefit cuts off the table and puts the priority on tax increases. So if we want to avoid economic disruption, if we want to give people time to plan and adjust, we have to be ahead of the curve. And then the box at the bottom shows if we acted right now in 2023, the payroll tax would be increased by 3.4%, or we would cut all benefits by 21%, or some combination of the two. But if we wait until 2034, the payroll tax has to go up that much more, has to go up 4.1%, and the benefit cut has to be that much more, 25%. So obviously, we do have an issue if we wait much longer. Okay. So the Academy has been very interested in educating the public on these kinds of issues. And so they invested a lot of resources in coming up with this. We used to have a program called the Social Security Game. A lot of folks didn't like calling it Game. So the relabeling called it Challenge. And it needed updating. So we updated it and put a lot of energy into communicating to the masses, basically. So basically, when you go there, you'll see a town, and all the folks in the town, they're kind of nerdy because they're all talking about retirement and Social Security. Even the 20-year-old coffee barista is talking about retirement, which is not normal, but that's what happens in the simulated town in the challenge. So anyway, it gives you a chance to review all the options for Social Security reform and pick your own package of reform options, considering how it's going to affect younger workers, near-term retirees, and reestablishing the system's health. So there's a link to it at the bottom. I highly recommend that you take a look at it. I went through it, and you'll come up with your own package. But the package I came up with is essentially, according to the program, solve the problem, was increasing the normal retirement age and indexing it. So in other words, phasing it up to say 69, and then having continue to go up thereafter with longevity increases. Some increases in tax rate and benefit base, not as big as they'd have to be otherwise if you didn't do anything else, but some increases. Reeling in the CPI index to a chained index instead of the fixed market basket. Resetting the accrual formula. If you're going to have people working longer, the formula is based on 35 years, can afford to go up, in this case to 40 years, and that's a cost saver as well. And then slight adjustments to benefits, adding to the minimum, and then some reduction to non-working spouse benefits. So that's the challenge. I highly recommend you take a look at that link and come up with a package on your own. So anyway, I do have some more slides to talk about investing, which I won't go into unless one of the questions pulls me in there. So let's take a look and see what the questions are.
All right, thank you, Jerry. So if anyone has any questions, please put them in the chat. I'll start from the older questions and move towards the more current questions. Number one, I think you already answered this, Jerry. Is the deterministic intermediate estimate the most likely result? I think you said yes.
Oh, yeah, that's what they would call it. They only do the others just to show there is a range. It's not necessarily the most thoughtful range of alternatives, and some of those assumptions in the high cost and low cost packages get a lot of criticism as a result.
Thank you. The next question is about trust fund alternative assets. So I think having an earned rate on the trust fund sounds a lot like an insurance company buying assets to back its liabilities. I think a lot of companies now are moving towards higher yielding alternative assets. Is there any kind of guideline or regulation that controls or tells what the government they can invest in for the trust fund?
Yeah, it's in the law right now, so the law would have to be changed. And there was more consideration to that back in the 2000s when the money was just starting to be accumulated and accumulating. And had we made a change then, a lot of times it came under the header of private accounts, but it didn't have to be private accounts. It could have been done lots of ways, but there were a lot of issues. It was controversial. There was the public control of businesses was a controversial issue. How investments would be selected. All these things were controversial. Had we done it, depending on the starting point, the system could have been in a lot better shape. But the reason I'm not covering those slides now is that it's become sort of a moot point now. Once we're in depletion mode, over the next 10 years, all the assets will be gone. It's not exactly the right time to start investing for the long term when you do not really have a long term. So that's why I'm not covering it. It's a very interesting question, but it was a much more interesting question 15 years ago than it is today, unfortunately.
Thank you, Jerry. Next question, was there a notable increase in worker beneficiaries due to COVID?
Yeah, I touched on that a little bit. No. The main thing that COVID did was it suppressed the payroll tax revenue for a very short period of time before it recovered, and it messed up the economy. It derailed lots of things like inflation, for example. The inflation increase went right to benefits, but it didn't go right to pay. And so that's a big problem for Social Security because it's the horse race between benefits and payroll tax income that dominates the system's health. And that took a little bit of a hit. And so the best way to think about the COVID impact is the inflation spike.
All right. Thank you, Jerry. Next, maybe more of a comment. We have had a decrease in longevity since the pandemic. aka higher mortality, but the assumptions is showing lower mortality, not just COVID, but also opioids. So I guess could you comment on projected mortality?
Well, I think the graph that we had before was a graph of longevity. So basically, you saw the mortality spike showing up as a downward spike in longevity. So that clearly happened, but the actuaries project a very strong recovery. And the actuaries are mostly interested in mortality, life expectancy at age 65. So all the statistics I showed you were life expectancy at age 65. And so the thing about the drug abuse and the lifestyle issues that are hurting American mortality patterns, longevity patterns, is that they're affecting a different age group. They're mostly affecting folks in their 30s and 40s, maybe into the lower 50s. They have not yet affected the retiree group. And so there is a question, a really important question about whether those morbidities will follow that age group into the retirement zone or not. I think the actuaries are assuming we're not, for the most part.
Thank you, Jerry. A couple more comments. The self-employed already paid twice the tax rate, I think the payroll tax rate. We need 2 new PIA points, one at the current cap with a 3% benefit, and one $1 million where the benefit is 0.25%. Do you have any comments on those?
Well, yeah, I'm not sure I understand the issue so much, because if you're self-employed and you pay twice the individual's tax rate, you're paying the same amount that's coming in for each individual because their employer is paying the other half. So not sure I could see the argument for a different formula. But let me just talk about how the formula works. The formula basically pays 90% of the first about $13,000 of average career wages. And then the next about 67% gets, I believe it's 32. So it's 32% on the bulk of pay up to $80,000. And then amounts over 80,000, which is about half of the amount up to the wage base, only gets replacement of 15%. So there's those three bands: 90% for very low pay, 32% for middle pay, and 15% for high pay. And so you do see some argument for another band if the tax base is increased. So, for example, one of the proposals that have come up in the Biden administration is putting a new tax base for amounts over 400,000. So if they were to do that, you have two questions. One, if you do that, are you going to provide a benefit? And if you're going to provide a benefit on those additional monies, is it going to be 15% or 0 or something in the middle? And I think something in the middle is the most likely outcome. And you just referenced 3%. That's a pretty, something like that might be most likely if a provision like that gets in.
Okay. Thank you, Jerry. And I have one question, and I might not type it just because I'm going to ask it. I think you mentioned during the presentation that a smaller percentage of GDP is going to labor. Can you expand on that, or is that just like an observation from the data set?
Well, it's an observation, but obviously folks try to microanalyze it and figure out what's causing it. So in a very simplistic fashion, GDP has to go somewhere, and it can go to labor, or it can go to capital, or it can go to government. So there's a chance that government's share has been changing over that period, but most of the attention is paid to capital. So the dynamic between labor and capital has evolved over the period since the 1970s in favor of capital. As the world became more global and access to global capital pools became easy, and outsourcing and all those things came into play, labor lost its power to command pay increases. Because if labor here is demanding too big of a pay increase, well, we'll just open a factory somewhere else. And so that drove income away from labor towards capital. And then for the last 15 years, we've had very liberal monetary policy, which lowered interest rates and raised all capital prices. And so the argument for doing that was to increase the environment for labor, which it may have done to some extent, but it also made a much more favorable environment for capital, and obviously raised stock prices. So capital got a good share of that monetary policy bump.
Okay. Thank you, Jerry. Next question. You mentioned that the 2008 financial crisis was a more recent negative turning point for the Social Security system. Was this primarily a result of the payroll tax holiday for the year, or due to the economic recession, or a combination of both?
Yeah, I know there was a payroll tax holiday, but believe me, that didn't hit Social Security. That was funded by the federal government, so that's off the table. Yeah, anytime folks choose to stop working and don't come back, that's a problem for the system. And so that happened a lot more in that recession than it did in this one. We're still trying to figure out whether the 65 plus folks who left the workforce are going to come back. But I can tell you this, they're not collecting Social Security. So whether that means it's a financial policy decision to not come back and not collect either, or whether they intend to come back, that's a big question.
Okay, thank you. And last comments, you need to provide a benefit due to the social insurance universality. The self-employed, lower income tax folks, I think pay twice the tax. It can be very regressive tax. I think this might be a follow-up to one of the initial comments.
Yeah, I mean, the thing is that whatever the tax is, 6.1% or whatever, every worker is getting 12.2% paid on their behalf. And so not charging a worker that amount would be a problem for the system. So the fact that they're assessing it from a different pocket, from the system's point of view, is not a super relevant issue. Charging less would be a big issue. In fact, before the 1983 reforms, I do believe that the individual self-employed workers were paying less. I think they were paying maybe 150% and not 200%.
Okay. All right, thank you, Jerry. Okay, one more question and then we'll cut it off. And that's final. How about saving the system by saying every worker with X quarters past contribution over 55 or 60 can immediately opt out? Wouldn't that give the system pure actuarial gains for some X, or is this topic prohibited?
I'm not sure whether that means a benefit formula or just deferral of collection. So basically, I think what you're saying is an incentive to defer collecting. Well, I mean, honestly, they have a really strong incentive in there for deferring collection now with the 8%. Every year that you wait past your normal retirement age, you're getting an 8% bump. I mean, that's when interest rates were 3%, that was a huge subsidy. Now, with interest rates of 5%, not so huge, maybe not even a subsidy. But anyway, so they're sort of already trying that in one way or the other.
Okay. Thank you, Jerry. I think that is all the time we have for this presentation. Thank you again. And I'm going to stop sharing my screen. I think